The financial reset is already happening. Here's what you need to know. If you've been feeling like something big is shifting in the global economy but can't quite put your finger on it, you're not wrong. A lot is happening right now, and most of it isn't making front page news in a way that connects the dots clearly. Let's walk through it together. The petrodollar is finished. For over 50 years, there was a simple rule that governed global finance. If you wanted to buy oil, you needed US dollars. Every country on earth had to hold dollars, which created permanent demand for the currency and gave the American financial system enormous power. That arrangement is now over. The key agreement that held it together was not renewed. Countries can now trade oil in whatever currency suits them. This is not a minor adjustment. This is the foundation of the post-World War II financial order cracking apart. And if you've been watching energy markets, currency movements, and gold prices, you're already seeing the early effects. What the markets are telling you right now, gold is trading above $4,700 an ounce. Silver is sitting around $75. Oil has climbed to roughly $110 a barrel. Stock markets have dropped significantly in recent weeks. These numbers aren't random noise. They reflect a market beginning to price in something that most mainstream commentary hasn't fully acknowledged yet: the possibility that the current financial architecture is being replaced, not just reformed. The central bank situation. There are several signals worth paying attention to regarding the future of the central banking system. A new central bank chairman is stepping in mid-May. He has a reputation for questioning the fundamentals of how the current system operates, not just tweaking interest rates, but asking bigger questions about the structure itself. Perhaps more striking, a recent Treasury announcement described new currency coming this summer. The announcement covered the US dollar, the economy, and the financial system at length. What it didn't mention, not once, was the central bank. That's either an oversight or it's intentional. Given the current environment, intentional seems more likely. The debt trap? Explained simply. Here's the core problem with the system we've been living in. Every dollar created comes attached to a debt. Interest is charged on that debt. But here's the catch. The money to pay the interest was never actually created. So you have to borrow more to pay back what you already borrowed plus interest. Do that for 50 years without a reset, and you end up exactly where we are, with debt levels that have no realistic path to repayment through normal means. The last three major financial resets happened in 1933, 1945, and 1971. We are now the furthest we have ever been from the last one. Something has to give. A word on your bank deposits. This is worth knowing, even if it's uncomfortable. Legislation passed in a previous administration changed the priority order for how banks handle their obligations in a crisis. Under those rules, a bank's debts to other financial institutions rank above their obligations to depositors. In plain English, if a large bank gets into serious trouble, it can cover itself before it covers you. Credit unions generally don't carry the same exposure to complex financial instruments that create this risk. That's worth factoring into where you keep your money. It's also worth noting that major wealth management firms are quietly raising their recommended allocation to physical metals, from around 10% to closer to 30%. The people managing large pools of money are hedging. That tells you something. Gold leaving U.S. vaults. One of the more significant recent developments has received very little attention. A major European country just completed the process of moving all of its gold reserves out of U.S. custody and back home. Another large European nation is now discussing doing the same. This kind of thing hasn't happened in over a century. When countries start pulling their gold home, they're expressing a view about where power is shifting. They're not doing it for logistics reasons. They're doing it because they sense the old order is changing and they want their assets under their own roof before that transition is complete. Physical silver versus paper silver. If you follow precious metals at all, you've probably noticed the price has been somewhat volatile. Here's some context that explains why. The traded price of silver, what you see quoted on financial sites, is largely determined by paper contracts, not actual physical metal. Estimates suggest there are roughly 300 paper ounces in circulation for every one real physical ounce. When powerful financial players want to push the price down, they sell paper. But something interesting has been happening. Every time silver gets pushed towards 68 or 70, buyers step in immediately and the price bounces back up. A floor is forming. Meanwhile, physical silver is quietly disappearing from storage facilities at a rate not seen in years. And for 6 consecutive years, the world has consumed more silver than it has mined. That gap has to close eventually. And when it does, the price will reflect reality rather than paper promises. The hard truth about what's coming. Let's be straightforward here. The transition from one financial system to another is not going to be smooth. There is a credible argument that the correction ahead could be severe, more severe than what we saw in 2008-2009. Pensions, investment accounts, and real estate values are all potentially exposed. Living standards may fall during the transition period. Supply chains could face disruption. The 1929 parallel is worth sitting with. In the months before the crash, life looked completely normal. People were going to work, shopping, building, investing. And then almost overnight, everything changed. The difference between then and now is that you have advance warning. You have time to make decisions while things still feel relatively normal. That window doesn't stay open forever. But here's the other side. If the reset unfolds the way many analysts expect, what comes after the difficult transition is genuinely promising. Wars winding down means energy prices fall and inflation eases. A restructured central banking system means rates can come down meaningfully. A return to tariff-based government revenue could eventually reduce or eliminate income tax. A manufacturing resurgence creates real jobs and real wages. A new currency system backed by hard assets protects the value of your money going forward. The disruption is real, but so is what's being built on the other side of it. What you can actually do right now. You don't need to panic, but you do need to act thoughtfully. Here's a simple framework. Protect what you have. I remember 12 years back joking about Grandpa's silver coins. Now, I get it, and am thankful to understand our founders' reason behind an asset-backed currency to stabilize price and utility. In fact, physical gold and silver have preserved wealth through every financial transition in recorded history. That's not investment advice based on hoping prices go up. It's historical observation. Both metals survive system changes. Paper assets often don't. Know where your money is. Understand your bank's exposure. One question you can ask is if it's a Tier 1 bank. A Tier 1 bank is a financial institution considered the most stable, reputable, and influential, typically operating globally with the highest capital adequacy. Consider whether a credit union makes more sense for your situation. Look at whether your retirement account is in products that could be wiped out versus those that have some downside protection built in. Build some resilience at home. No fear-mongering, but I always tell my clients to stock up on their favorites. In addition, consider basics like water, basic medicines, and a small emergency fund as a practical cushioning for a bumpy transition period. Stay informed. The mainstream financial media will be the last to tell you a system change is coming. They are lockstep with the psyop and control markets. Research Aladdin and the stock market, and you'll understand. Price forecasts to watch. For those tracking metals specifically, here are the ranges being discussed by informed analysts. Metal potentials for 3 years out. Gold $6,500, $10,000, significantly higher if revaluation occurs. Silver $150, $300, potentially $500 plus. If physical shortages intensify, these are not guaranteed outcomes, but they reflect serious analysis of supply, demand, and the structural dynamics described above, not just chart patterns. The bottom line. We are living through a financial transition that happens once in a generation, maybe once in a century. The petrodollar era is ending. The central banking model as we've known it is under serious pressure. Debt levels have reached a point where a reset isn't a possibility, it's a mathematical inevitability. The question isn't whether things will change, they already are. The question is whether you're positioned to get through the transition and land well on the other side. The time to think about that is now, while things still look relatively calm. Stay informed, stay prepared. And as always, think for yourself.